So Lendlease recently released its full year 2024 results, and numbers were not good at all. While full year gross revenue and net property income saw positive year-on-year increases, it includes a significant one-off supplementary rent due to the lease restructuring of Sky Complex. Excluding this one-off item, the increase will be more models at 3.2% and 1.3% respectively. Currently, we don't know how much of this supplementary rent was included, if at all, into distributable income for FY 2024, as Lendlease REIT does not disclose distribution adjustments in its financial statements or results presentation. The adjustment will only be displayed in its annual report. Thus, if a supplementary rent was included and recognized fully in the distributable income and consequently the DPU for FY 2024, the year-on-year decrease will be much worse than illustrated without the supplementary rent. A large part of the huge decrease in distributable income and DPU was due to higher finance costs and an enlarged unit base. And the bad news, it only gets worse before it gets better. To say that interest rates have negatively impacted Lendlease REIT would be a massive understatement. From FY 2022 to FY 2024, Lendlease REIT's finance costs has ballooned by a whopping 324.6%. The reason for this huge increase in finance costs is largely due to a low proportion of fixed rate borrowings that Lendlease REIT has. For FY 2023 and FY 2024, the proportion of Lendlease REIT's borrowings on fixed rates was only at 61%, while the proportion of fixed rate borrowings will increase to 70% post FY 2024. I think it's too late, as the REIT has already felt the full brunt of high interest rates. Nonetheless, with rate cuts coming soon, there might be marginal improvements in Lendlease REIT's finance costs moving forth. In addition to low proportion of fixed rate borrowings, Lendlease REIT is negatively impacted by its own credit rating and size during refinancing. As compared to bigger and more reputable REITs, i.e. your CapitaLand, Keppel, and Mapletree REITs, Lendlease REIT's interest rate margin on its loans will likely be higher than its more established peers. This further explains why Lendlease REIT's weighted average debt costs jumped by almost 90 basis points as compared to the previous year, mainly due to refinancing of euro-denominated loans on previously lower interest rate and the drawing of revolving loan facilities in SGD. Also, after accounting for debt-related transaction costs, Lendlease REIT's actual cost of debt is actually way higher at 4.4% than the illustrated 3.58%. With 360 million SGD of loan to be refinanced at FY 2025, Lendlease REIT's cost of debt could continue to rise, although it's dependent on the interest rate environment that Lendlease REIT refinances its loan in. As per DBS analyst report, Lendlease REIT's management expects a 20 to 30 basis point increase in its debt cost for FY 2025, without factoring in the SGD loan refinancing. Thus, this relates to approximately 2.7% to 4.3% decrease in FY 2024 DPU on a pro forma basis. Besides the negative impact on DPU, Lendlease REIT's higher average debt costs also resulted in a lower interest coverage ratio and adjusted interest coverage ratio. With an adjusted ICR of just 1.7 times, the REIT's resultant aggregate leverage limit would thus be 45% instead of 50%. While MS is currently proposing a fixed aggregate limit of 50% and a minimum adjusted ICR of 1.5 times for all REITs moving forward, this proposal remains in the consultation stages and has not yet been implemented. In addition to the negative impact of high interest rates on Lendlease REIT's future earnings, the REIT is also hampered by its own large unit base. This is one of the factors behind the huge 17.7% DPU decline we see in FY 2024. If you look at the management fees for FY 2022 and FY 2023, you can see the majority of it is paid out in units. Based on unitholders' transactions for FY 2024, this trend looks set to continue. On one hand, having most of the REIT's management fees being paid out in units indicates a large DPU decline as compared to if cash has been paid out instead. On the other hand, the REIT is left with an enlarged unit base, which makes future DPU increments either via organic or inorganic means a tad much harder. Adding on to this conundrum is that the REIT has its own distribution reinvestment plan. If you ask me, I think it's foolish to sell a DRP when the REIT is trading below its NAV per unit. By doing this, the REIT management is effectively diluting unit holders at will. As a result of both DRP and the majority of management fees being paid on units, Lendlease REIT's unit base in FY 2024 increased by 2.3%. This enlarged unit base also resulted in the decline of Lendlease REIT's NAV per unit in FY 2024. If Lendlease REIT continues enlarging its unit base going into FY 2025, I fully expect DPU to continue declining. This on top of the possibility of a lower distributable income due to the reset of one of its perpetual securities. Lendlease REIT Series 2 perpetual securities will reach its first reset date on 11 April 2025, with the reset rate being the prevailing 3-year SORA OIS plus a spread of 3.043%. We'll likely take the perpetual securities yield past its original yield of 5.25%. While Lendlease REIT can issue new perpetual securities under its $1 billion multi-currency debt issuance program to redeem the older perpetual securities, there is no guarantee that the yield of new perpetual securities will be lower than 5.25% or the corresponding reset yield given the interest rate environment and Lendlease REIT's own financial health. Thus, if the expectation that the yield will be higher than 5.25%, coupled with the previously mentioned enlarged unit base, we could see another significant decline in DPU in FY 2025. Nevertheless, any negative impact to distributable income and DPU can be avoided or at least reduced if Lendlease REIT records exceptional operational financial numbers. To assess the possibility of this, let's look at Lendlease REIT's property performance and future growth drivers. While Lendlease REIT's bottom line figures were poor, its Singapore properties actually did very well. Both 313 at Somerset and GEM recorded close to full occupancy rate as of the end of FY 2024. Retail rental reversion also came in at a high positive number of 14%, with tenant retention coming in at 84.9%. These figures tell us that Lendlease REIT's two main shopping malls remain attractive to current and potential tenants. This is further evidenced by the increased valuation of these two malls in FY 2024, with retail market rental rates seeing a slight year-on-year increase in the second quarter of 2024. Lendlease REIT's positive rental reversion trend might hopefully continue for longer. However, it should be noted that Lendlease REIT's high retail rental reversion numbers could have been for the renewal of leases from relatively low rental negotiated during the COVID-19 pandemic. While I hope that positive rental reversion does continue for the growth of the REIT, investors should be too overly optimistic about it, nor should they expect a high double-digit rental reversion figure. Also, based on Lendlease REIT's tenant sales and visitation figures, it only recorded modest increase from FY 2023. This might allude to potential slowdown in the pace of rental increases. Besides relying on positive rental reversion for growth, there are other growth avenues for Lendlease REIT in the form of its commercial office properties and a multifunctional event space at 313 at Somerset. With the lease restructuring of Sky Complex in Milan, Lendlease REIT has taken back Building 3 and will be leasing it out as a regular commercial office building. This provides a potential upside to both gross revenue and net property income, as Sky Italia was previously paying below market rental rates for all 3 office buildings in Sky Complex. Furthermore, annual rental reviews for Sky Italia will also likely provide incremental improvements to rental income every year. However, as per the analyst report from DBS, it might take some time for Building 3 to be filled out. Besides Sky Complex Building 3 in Milan, financial upside could also come from the office building of GEM. Currently leased to M&D till 2044, its once in 5 years rental review is set to take place in FY 2025. If the rental rate to be revised higher, it should provide upside to Lendlease REIT's top line figures. Since the announcement of Lendlease REIT being awarded the tender to redevelop Branch Road Car Park into a multifunctional event space back in June 2020, there has been no further news or update regarding the construction progress. If they visit the construction site for the multifunctional event space, it will be greeted an empty plot of land with patches of overgrown grass. During Lendlease REIT's last AGM back in 2023, the CEO informed that construction will start either by the end of 2023 or early 2024. I think it's safe to say that nothing has started at all. With an expected net lettable area of 40,000 square feet, the multifunctional event space could ultimately provide some upside to Lendlease REIT's financial figures once it is completed. The only question to ask is when that will be, as the construction for the site will take 12 to 18 months to complete. As a whole, after considering both the negative and positive aspects of Lendlease REIT, I foresee that FY 2025 DPU will likely see another decline. While Lendlease REIT could benefit from the previously mentioned potential rental upsides, I don't think it can outweigh the negative impacts of an enlarged unit base and continued high finance costs. Also, if a supplementary rent from Sky Italia was recognized fully in FY 2024, FY 2025 DPU will thus naturally be lower due to its absence. Hence, if you're currently holding of Lendlease REIT, be mentally prepared that the share price could continue to decline as the market will likely demand a high yield premium for the REIT.